Hey, it is Troy Stavros with Doorbell Real Estate, and I just wanted to talk to you today about the difference between the crash last time when we had a bubble and what is happening right now. I find that anytime I get the same question from multiple people, it's a good idea to write an article or do a video just explaining what the scenario is now compared to what somebody may be thinking. So, for example, we know back in 2007, 2008, when the market went crazy and then collapsed, everybody remembers that. And now, with prices of homes skyrocketing the way they are now, people are worried that the same thing is happening. So, what I want to go over in this article, in this video, is 6 simple graphs that show you that what's happening right now is not like it was the last time. So let's get into it. So last March, many involved in the residential housing industry feared that the market would be crushed under the pressure of a once-in-a-lifetime pandemic. So instead, real estate had one of its best years ever in 2020. Home sales and prices were up both substantially over the year before. 2020 was so strong that many now fear that the market's exuberance mirrors that of the last housing boom, and as a result, we're headed for another crash. However, there are many reasons this real estate market is nothing like the one in 2008, and I'm going to show you 6 visuals that show a dramatic difference between the two. Okay, number 1, mortgage standards are nothing like they were back then. During the housing bubble, it was difficult not to get a mortgage. Today, it's tough to qualify. Recently, the Urban Institute released their latest Housing Credit Availability Index, which, quote, measures the percentage of owner-occupied home purchase loans that are likely to default. That is, go unpaid for more than 90 days past their due date. A lower HCAI indicates that lenders are unwilling to tolerate defaults and are imposing tighter lending standards, making it harder to get a loan. A higher HCAI indicates that lenders are willing to tolerate defaults and are taking more risks, making it easier to get a loan. So let's take a look and see what they're doing. The index shows that lenders were comfortable taking on high levels of risk during the housing boom of 2004 through 2006. It also reveals that today, the HCAI is under 5%, which is the lowest it's been since the introduction of the index. The report explains, significant space remains to safely expand the credit box. If the current default risk was doubled across all channels, risk would still be well within the pre-crisis standard of 12.5% from 2001 to 2003 for the whole mortgage market. So let's take a look at this graph. As we look from 1999 to 2008, 2009, when we had the crash, you can see there was significantly more risk for default in the mortgage market. As we look now, 2020, we are lower than we have been since 1999. So this is a huge factor as to why now is nothing like it was in 2008. And that's just number 1. Let's go on to number 2. Prices aren't soaring out of control. While they might seem like they are not soaring out of control. Let's look at the difference between now compared to 2008. Below is a graph showing annual home price appreciation over the past 4 years compared to the 4 years leading up to the height of the housing bubble in 2008. Though price appreciation was quite strong last year, it's nowhere near the rise in prices that preceded the crash. Let's take a look at the graph. So 2002, 2003, we were at 8.5% and 8.7% increase in home price appreciation. Then 2004, 2005, 12.5% and 11.4%. If we look at the last 4 years currently, 2017, 2018, 2019, and 2020, in 2017, we were only at 6.4%, 2018, 4.8%, 2019, 4.7%, and 2020, 9.2%. So nothing like it was leading up to the bubble and the crash in 2008. So there's a stark difference between these two periods of time. Normal appreciation is 3.8%. So while current appreciation is higher than the historic norm, it's certainly not accelerating out of control like it did in the early 2000s. Once again, this is nothing like last time. That's number 2. Let's go on to number 3 reason. Number 3, we don't have a surplus of homes on the market. We have a shortage. The month's supply of inventory needed to sustain a normal real estate market is approximately 6 months. That is considered a healthy market. Anything more than that is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued price appreciation. As the next graph shows, there were too many homes for sale in 2007, and that caused prices to tumble. Today, there's a shortage of inventory, which I'm sure you know if you're looking at homes. They're just difficult to find, which is leading to multiple offers. And that is causing an acceleration in home values. Let's take a look at the graph. Leading up to the housing bubble in 2008, 2004, we were at 3.9 months of inventory. 2005, we were at 5 months of inventory. 2006, we were at 6.4. Then 2007, we were at 9.6 months of inventory. That is a huge overabundance of homes on the market. Let's look at what's happening now. 2017, we were at 4 months. 2018, 3.7. 2019, 3 months worth. And 2020, 2.1 months worth of inventory. Nothing like it was during the housing bubble. The complete opposite, actually. So while this number right here, 9.6, is going to lead to home prices dropping drastically because there's too many homes on the market, there's no way that's going to happen here because there's so few amount of homes available. Supply and demand. Okay, let's go to number 4. New construction isn't making up the difference in inventory needed. Some may think new construction is filling the void. However, if we compare today to right before the housing crash, we can see that an overabundance of newly built homes was a major challenge then, but it isn't now. So when we look at the graph, here at 2005, had 4 consecutive years of record-setting number of new construction units. So there was an overabundance of new construction. If we look here, the years leading up to now, we're well, right here, 13 straight years below the 50-year average. So the average annual units is to be completed is here. We are below that. So once again, not only like this graph up here where there were so many available homes on the market and today so little, when we look at new construction during the bubble, so many new construction homes available, but today so little. Completely different. Nothing like it was the last time. Number 5, houses aren't becoming too expensive to buy. Okay, the affordability formula has 3 components: the price of the home, the wages earned by the purchaser, and the mortgage rate available at the time. 15 years ago, prices were high, wages were low, and mortgage rates were over 6%. Today, prices are still high, wages, however, have increased, and the mortgage rate is about 3%. That means that the average homeowner pays less of their monthly income towards their mortgage payment than they did back then. Here's a chart showing the difference. So this chart shows the percent of the median income needed to purchase the median priced home. So 1985 to 2000, you needed 21.2% of your income on average to purchase a home, right? In 2006, leading up to the bubble, you needed 25.4%. And that's taking all those factors into consideration: the prices of the homes, what the wages were earned by the purchaser, and the interest rate. Now today, you only need 14.9%. So while prices are higher, wages are up, interest rates are lower, that means your monthly payment today is considerably lower to afford a home than it was any time between 1985 to 2000 and 2006 leading up to the bubble. Mark Fleming, chief economist for First American, explains lower mortgage interest rates and rising incomes correspond with higher house prices and home buyers, as home buyers can afford to borrow and buy more. So once again, lower mortgage interest rates and rising incomes correspond with higher house prices, allowing home buyers to afford to borrow and buy more. If housing is appropriately valued, house buying power should equal or outpace the median sale price of a home. Looking back at the bubble years, house prices exceeded house buying power in 2006, but today, house buying power is nearly twice as high as the median sale price nationally. Once again, this is nothing like the bubble in 2008. And number 6, people are equity rich and not tapped out. In the run-up to the housing bubble, homeowners were using their homes as a personal ATM machine. Many immediately withdrew their equity once it built up, and they learned their lesson in the process. Prices have risen nicely over the last few years, leading to over 50% of homes in the country having greater than 50% equity. And owners have not been tapping into it like the last time. Here's the table comparing the equity withdrawal over the last 3 years compared to 2005, 2006, and 2007. Homeowners have cashed out almost $500 billion less than before. So let's look at the graph. Total home equity cashed out through refinance in billions. Back in 2005, they cashed out $263 billion in home equity. In 2006, $321 billion, and in 2007, $240 billion. So those 3 years leading up to the crash, they cashed out a total of $824 billion of their home equity. And what that means is they went to the bank, they took out a home equity loan, and or they refinanced their house, and they took the cash out of the home equity that they had. They took out $824 billion worth of dollars. $824 billion worth of home equity. Now, the last 3 years, 2018, 2019, 2020, $87 billion, $108 billion, $153 billion for a total of $348 billion. Look at that difference. So once again, yet another reason. During the crash, home values began to fall, and sellers found themselves in a negative equity situation. That's where the amount of the mortgage that they owed was greater than the value of their home. Some decided to walk away from their homes, and that led to a wave of distressed property listings, foreclosures, and short sales, which sold at huge discounts, thus lowering the value of other homes in the area. With the average home equity now standing at over $190,000, that's not going to happen today. So once again, this is nothing like it was back then. Even if somebody got into a situation today where they could possibly get foreclosed on, home prices have increased enough that they should already have equity in their home. They can just put it on the market and it'll sell in a day like every other property. There should be no reason that they're going into foreclosure. They should be able to sell their home, pay off the bank, and just move on without a foreclosure. A huge difference than what it was like back during the bubble. So bottom line, if you're concerned that we're making the same mistakes that led to the housing crash, take a look at the charts above, and that will help alleviate your fears. Hope this has been educational. I know I got a lot of questions about this within the last few months where people are worried because home prices are going up. Are we going to have another bubble? Are home prices going to crash? Are they going to go down? The answer to that question is this is nothing like it was in 2008. All right, we will talk to you soon. Let us know how we can serve you. Hope you're having a great day. This is Troy Stavros with Doorbell Real Estate.